Hi, I'm Sam from Clark Mortgages. I'm a specialist mortgage broker. I deal with more complex mortgages. And I just wanted to talk about how you get into investing in property. How do you start building a property portfolio? Well, you start with your first property, obviously. But should that be your home or should that be a buy-to-let? Well, I will say, generally speaking, most people are going to go and buy their own home first. I think most lenders would prefer as well, unless you've got reasons behind you as to why you wouldn't, would prefer you to do that. There's other advantages. You know, if you're a first-time buyer, at the moment you get a stamp duty relief. Why wouldn't you make use of that? If you're going to sell it in the future and it's your residential, you get capital gains tax relief and things like that. So perhaps look at it as a residential first. But I'll tell you how I started. So I started buying as a first-time buyer. I bought a property for, I think it was £155,000, and it was from probate, which means that it was part of someone's estate and they had sold it. Hadn't been lived in for quite some time. It needed modernisation. Not a great deal, you know. Generally speaking, what we call a term mortgage, so a buy-to-let or a residential, usually requires the property be habitable to the greatest degree. So it was habitable, but it hadn't been updated probably since the 70s. So I bought it, and I bought it for £155,000. I put in a 5% deposit, which I'd saved up from employment. At the time, I didn't have my own business. I was just working as a broker under someone else. And I bought it, and I put a 5% deposit in, £8,750 including legals. And I bought it, and I moved in, and while I was there, I did it up. I think I did what pretty much every first-time buyer does, and to be honest, I'm the least handy person I know, so most of it I paid someone else to do. But I think a lot of people, you know, they get in and they repaint it and they put in their new kitchen and however they do it. Now, the value to me of that was that property values were going up at the time. And generally, I think property values do get up. I often speak to people that say, you know, I'm going to wait for interest rates to drop before I buy a property. Meanwhile, property value continues to rise. Not all the time, you know, there's drops here and there. You can't always say that it will be forever. But if we look in the long term, in the same way you look at the stock market, the FTSE 500 and whatever it is you invest in, generally speaking, it's all gone up. Anyway, so I bought it and property values shot up, actually. They went up by about 8% in that year. And I'd done a little bit of work. And generally speaking, if you buy a property, the right property, you can pay a relatively small sum and get a good return on investment. 2 years later, I was in a position where I'd been saving money myself anyway. I was still in a good job, still being a broker for another company. And from there, I decided, well, I'm ready to move. Let's have a look here. And the value of my property had increased as such from the work that I'd put into it. Luckily, I had the finance, the funds to be able to pay for it myself. You can always get that on finance as well. We added value to that property, and that was then worth £180,000 by the time I came to get it revalued in 2 years' time. Meanwhile, my mortgage, which I'd taken out, which had been about 147 or somewhere in that region when I took it out, I'd paid down to the tune of about £140,000. When we looked at it then, I was able to benefit from a buy-to-let remortgage on that property, and I was able to then turn that into a rental. Use your equity to scale up. From that, I was able to then buy a new residential property because I had funds available. You know, not everyone has the benefit, as I did, of having a good job, living below my means, being able to save, but I did. And I used the equity to turn that into a buy-to-let. All of a sudden, that was immediately from what was only a 5% investment from me, based on a little bit of work and a little bit of relying on the reality that property value increases. I was then able to use that equity to turn it into a buy-to-let. And I had to pay it down slightly, granted, but again, I just chalked that up as to the cost of my next purchase. And I bought my next property, and that next property, I again put 5% deposit in. You may say, well, you've got another property there in the background, but because I was converting that into a buy-to-let, that didn't actually impact my next property purchase, because lenders a lot of lenders at least, will ignore a buy-to-let in the background on the understanding that it will be self-financed. So they looked again and they looked at me and they said, right, well, we can lend you this. So the next property I bought was 205,000. And it was similar. There was less to do to it. But again, I put a bit of work into it, and a year or two went and a revaluation came up and that property was worth 250,000. That equity increase was so much more than I could have saved. That's the power of equity, and that's where it's going to scale you up. I was able to realize money out of that, and from there I bought my third, which was a much smaller project because at the time I didn't need to, and I ended up changing tax because I decided to start my business. But that's not the point. The point is you use the equity because it's so much quicker than saving. Because this is the point. So in my case, I bought a property, that first property I bought with £7,750 basically, and a mortgage. Yes, the property went up £30,000. That's great. And you look at the property value and you think, right, well, brilliant. I made, 20%-ish, a little bit less. But I didn't own that property outright myself. I owned it with a mortgage. I'd bought it with a 95% mortgage. So when all's said and done, what I had actually done was employed £7,750 of cash, and that return on capital employed was 30,000. Do you see? So what actually happens is, although I buy the property with the mortgage is not tied to the equity. The mortgage is the mortgage. The mortgage is a loan. The equity in the property is entirely mine. So all of a sudden, I have £400,000 worth of property value that's entirely tied to my name. Yes, it's heavily leveraged. However, all of the growth in that property is my own. So if property goes up 10%, I benefit from, £400,000 worth of total asset value. From £400,000 growing, £40,000. The mortgage lender doesn't. So that's a really interesting point of leverage, is that I was then able to take money out. And I will say, the caveat to this is a fairly high risk growth strategy, because you are repeatedly leveraging money. There's a counterweight to the risk in that I am then putting it into another property. But what I will say is that there are a couple of things. Firstly, if I ever needed to disinvest, it becomes much harder because I've got multiple properties to do it with, which means multiple sets of fees to leave, multiple estate agency fees. So that can infringe on my total asset value. On top of that, I'm now much more heavily affected by the market, because I've gone from having a property worth 150,000 to, cumulatively having 500 grand's worth of property. However, it goes the other way. Property can go up 10% and I can make 50 grand. Property can go down 10% and I can lose 50 grand. So you can't always rely on being heavily leveraged. If we do have these, these slight jiggles in the market where things go down slightly, people have been negatively affected by that, which is why I was fortunate in a place where, when all said and done, I did have a good job behind me. I was making good money. And this is where we talk about, choosing between capital growth and cash flow. So we leverage property. You can scale so much faster than you can by saving. But if you look at property, it's going to do one of two things. Generally, a property is either going to increase in value or cash flow. A great property will do both. If you can buy a property, grow a property and still cash flow it, absolutely fantastic. However, generally you have to pick one. Capital growth, longer term, poorer cash flow. Cash flow means you're going to rely on that to then invest in new property. I would say perhaps I have seen, and this is anecdotal evidence, I don't know whether it's true or not, I've seen faster growth on a capital growth based portfolio compared to a cash flow one. Generally, properties at the lower end of the market, I do think perhaps get left behind by property appreciation. You'll find, you know, in certain coastal towns, there are properties that were sold in the 90s for 90,000, and even now they're still being sold for 90,000. Whereas properties in cities, you know, generally are increasing much, much faster. But capital growth, the benefit is that it's non-taxable until you realise it. So if you sell the property, you're going to pay capital gains tax. The benefit to that is that when you refinance it, you can then take out a lump sum tax-free to invest into further properties. But as I say, you are relying more on the market than you are on cash flow. It's more akin, I would say, to a stock investment at that point than it is to creating a passive income. And I think a good property portfolio probably has a bit of both. Long term, you're going to look at property and you're going to say, okay, well, long term, property is going to go up, probably. Who could say? You know, there might be a crash. Who knows? Short term, you may say, well, let's cash flow or let's create immediate increases. This is what's been most interesting, I suppose, about having people react to the higher interest rates. A lot of people, I think, got comfortable with the idea that we were making great profit on a climate where buy-to-lets were about 2% and we were making 6% gross yield. That was a great profit, brilliant, tax get paid, happy days, off we go. Now it's much, much more difficult to cash flow that kind of property. So instead, I think a lot of people have been looking to the long term by adjusting their short term, I suppose would be the right way to say it. They are looking to the long term because people are still accumulating properties in the expectation that property is going to increase. They're also doing it in the long term on the expectation that rates, perhaps in the hopes, who knows, but rates are starting to fall and rates perhaps can't sustain themselves being as high as they are forever. So they acquire property now as quickly as possible so that they can then benefit long term from that cash flow. That means that the short-term acquisition strategy has to be high-geared capital growth. And the only way to do that is by adding value in some shape or form. So adding value can be from a number of different places. And that's what we'll explore in other videos. But really, if you acquire a property for 100,000, you put £25,000 of your own money in. If you are then able to spend 20,000 and get it refinanced at a valuation of, let's say, 180,000, well, don't you then get all your money back out? Surely then you can just do the same again. And that's what a lot of people are doing. So it's short term to enable the long term. I think you should have a strategy for both, but it's important that you don't just rely on one because you're going to get caught short at some point.